Well, we also had some major tech downgrades out of JPMorgan this morning. Doug Anmuth leading the team there. 26 companies had their estimates and price targets slashed, and this has to do with what we've just been talking about, this outlook for the economy. Alphabet, Amazon, Meta, Netflix, Snap, Twitter, and more are on this list. And this is because Anmuth and his team are looking at what the economists at JPMorgan are saying. They're saying there could be a 66% chance of recession over the next 2 years. What's the effect going to be on these companies? Nothing good is the long and short of it here. The biggest estimate reductions, he says, come in online advertising and e-commerce, although they're cutting for a lot of different stuff. They are saying we believe buy-side expectations and many equity prices already reflect a softer macro environment. So even though he's cutting a lot of these estimates, he's still saying some of this could already be priced in.
Yeah, look, I understand these calls, but I'm going through this list. I'm not seeing any sell ratings, and I'm a little surprised to see overweight recommendations on Uber and Lyft, and I know the price targets are coming down, but if you're looking at a 66% chance of a recession over the next 2 years, you would think you would maybe get a little more aggressive with these ratings, a little more aggressive with these price targets. Even the price target reductions on Alphabet, Amazon, Meta, Netflix, they're still above where the stock is currently trading. So it's sending a lot of mixed signals, I think.
The thing that did jump out to me, though, the 10 companies out of this 26 that were advertising revenue-driven businesses at the end of the day, where you have Alphabet, of course, Amazon, Meta, Snap, Twitter, the list goes on. And I think for companies that are looking across some of their own cost restructuring right now, where they are pulling back on that ad spend, that's a theme that's going to likely play out itself in this earnings season as well, when we hear from companies to see exactly how much they are pulling back on that spending and how that's going to impact their revenue at the end of the day, too, in net client or customer acquisition. But then even more so from here, it comes at a time where CEO confidence is waning. We saw that show up in even more data that was out from the Deloitte and Fortune CEO survey. More than 80% of CEOs surveyed expect inflation to influence or disrupt their business strategy within the next 12 months, and that's now surpassing labor and skill shortage from its previous top position.
One of the other things that Anmuth says in this note that I think is really interesting context, he's comparing this period to the 2008-2009 financial crisis and obviously recession there. He says the key difference is that digital only accounted, this is 12% of total ad spending at that time. You want to guess at how much it accounts for now?
I'm going 60.
67%.
Oh, there we go. That's close.
No, in between the two. 67% in 2021. He says, so online spending is now far more exposed to broader macro trends, which makes sense, right? So it's interesting to see this sort of big picture view of how all of this is going to play out between the CEO confidence and slowing economy.
Yeah, on recession, where we just mentioned JPMorgan, Citigroup, Nathan Sheets, friend of the show, also out this morning saying there's a 50% chance of a recession next year. Deutsche Bank's Matthew Zetti, 2 weeks ago, his economist raised up pulled forward his recession timeline for next year. So these calls are starting to pile up on a recession.
He's got to change his last name to Wawa, though. Much better than Sheets.